What is up, you guys? Nick here. Welcome to the show. In this video, I'm going to be discussing the best plays for your portfolio. I'm going to be analyzing and discussing stocks that will benefit from our economy and our markets emerging out of this pandemic era health situation. There have been a lot of companies that have benefited greatly from the health situation. However, many of these companies that have already benefited may see sharp corrections coming as their era in the sun, so to speak, may be coming to an end. I believe it's the revenge of the stocks and the companies that have been shuttered for the past 8 months. These guys may be ready to strike. If you haven't already, hit that subscribe button. I do a ton of videos like this going over EV stocks, tech stocks, with a focus on disruptor companies to keep you ahead of the curve and to dominate the stock market. Smash that like button while you're down there. And without further ado, let's get right into it. Alright, the first company I want to talk about is a company called Welltower. This is a company I've talked about in many of my other videos and remains one of my favorite REITs I currently own. They are the largest healthcare-focused real estate investment trust and have been one of my favorite REITs for years. Their share price is sitting at $67.84 and they still remain roughly 25% down from their March highs. Welltower is a real estate investment trust but is outperforming many other REITs, and here's why. They are focused on post-acute facilities, hospitals, assisted living centers, and senior housing. With a rapidly aging American population, these centers will increase in necessity in the coming years and decades. Persons aged over 80 are expected to double in the coming 15 years. Additionally, in a post-pandemic world, healthcare, the treatment and care of seniors and of the mass public will only increase. REITs have been battered by the health situation, and if you are a long-term investor, you will be getting these shares at a massive sale price. The necessity of senior housing demand will increase over this time and into the foreseeable future. I would not be surprised to see the stock back up to its March highs sooner rather than later. As its fundamentals are strong, it has an extremely wide moat, and we actually saw it outperform many other REITs during the health situation in that it primarily focuses on necessary centers that are needed regardless of the current state of the world. In other words, this remains a safer option than some other REITs in that even if the new Pfizer vaccine doesn't reach full clearance and the Rona persists, it is still essentially shielded. They also pay out a very nice dividend with a yield currently sitting at 3.60. Welltower absolutely demolished their Q3 earnings by 61 cents a share and have actually beat earnings the past 4 quarters. They continue to reliably increase revenue year over year with an expected dip this year due to the health situation. However, mark my words, will return to normal revenues extremely soon. They have an extremely strong profit margin of 21.90, a return on equity of 661, 4.75 billion in revenue in the trailing 12 months, 241 in gross profit, 1.6 billion in cash and cash equivalents, and a current ratio of 3.83, signifying far more assets to liabilities. And remember, they also pay out that very attractive dividend. We have to think long-term here. I'm strictly a long-term investor, and I'm always thinking of at least 3 to 5 years out, and this is one to buy and hold on for the long run. Alright, moving on. With talks of vaccine, many extremely eager people are gearing up and increasingly antsy for travel. There's so much pent-up demand for travel, entertainment, and leisure. It is truly wild. I, for one, am personally experiencing these sentiments. Once a worldwide vaccine is out, people are immunized, many of these current sentiments and feelings surrounding travel and leisure will seem like a very far away dark dream we all once had, and people will happily get on planes and travel again. United Airlines is currently my favorite airline watch. Yes, I said watch, as this is a slight caveat. As the big Pfizer announcement shot up these airline stocks much too fast, I think that in the coming weeks, if not months into the winter, we will see a steady correction take place. I think this feeding frenzy over airline stocks was a bit premature, as there are many struggles to come for these airlines. However, there are many signs of hope and strength looming, and let me explain. Shares of United are up 18% over the last 5 trading days, yet down more than 55% since the health situation shuttered the industry. United is currently predicting that the week of November 25th will be their busiest since March, and we are clearly seeing an upwards trend. They are adding an additional 1,440 flights back to their roster and will have larger planes at the ready in cases of customer surge. We are finally seeing the path to recovery. Furthermore, they will fly at 52% capacity in December, which is up 3% from this month, November. In by no way, shape, or form am I saying this will be an easy journey for the company, and they will face struggles and obstacles in the coming quarters. However, my investment strategy has and always will be long term. If we look at what was occurring up until this year, continual upward movement, more and more people were flying, exponential exponential growth and simultaneously becoming cheaper. Although many economists are saying that airlines will suffer ramifications of this pandemic for at least 5 years, once we emerge, and we will emerge, airlines will be as popular as they once were, if not much more. Globalization will continue, people will continue to travel, and airlines will become ever increasingly accessible and normalized and affordable. United has tough times ahead, however, it continues to become a stronger and stronger long-term buy and hold as its shares continually fall. Remember, people, long-term thinking. Keep this one on your watch list, as I do think it'll suffer more damage before we see these sweet gains. This next one is a company that has shot into the mainstream this past week and will continue dominating headlines over the next few months, if not years. Pfizer. It's one of the largest biopharmaceutical companies on the face of the planet. This is a company I have talked about in past videos extensively. They are by far my favorite biotech and biopharma company in that they are so massive. It's honestly hard to wrap your head around just how big and wide-moted this company truly is. Having just developed potentially the first vaccine, this is a major accomplishment for them and the entire world. However, this isn't actually the main reason why I'm purchasing additional shares of this company moving forward. The main reason I am purchasing Pfizer is that they are the top dog, so firmly rooted in controlling an industry that will continue to see an increased importance. Pharmaceuticals, antibiotics, antivirals, antifungals, biotechnology, and biopharma will see an increase of funding and importance in mainstream life in the coming years. This, paired with a rapidly aging population and an increase in prevalence of so-called superbugs, will force the hand of governments into spending additional dollars on preventative and combative healthcare. Unfortunately, disease is only becoming more prevalent as we live longer and become more populated. The list of drugs and clinical trials Pfizer currently has patents on is immense and shows you just the true vastness, power, and potential this company holds. It really is incredible. They also have an immensely strong balance sheet and figures, and also pay out an increasing and very reliable dividend, currently sitting at 3.93%. Their stock is already in correction after their big Monday announcement, and will very likely pop once again they release more information and a third party tests their vaccine for efficacy. They have an incredibly high $214 billion market cap, have a 25.15 PE, and a 1.54 earnings per share. They beat estimates the past 3 quarters and even increased earnings while seeing a hit to revenue just last year. They will continue to dominate the biopharm and biotech space and are essentially too big to fail at this point. Their forward PE is only 11.78 and price to book of 310. They are a very stable stock with a beta of 0.64, have 11.4 billion in cash, and have an average price target above their current price. This is a long-term play for stable and reliable gains. If you want exposure to the healthcare sector, the biopharm industry, this is a very safe bet and will essentially act as a hedge, smoothing out your portfolio for the foreseeable future. Alright, this next one's crude in that I'm going to be going a bit of a different route for this one, in that it's more anecdotal, and it's also crude in that I am focusing your attention towards natural energy stocks. There's a pun. Natural gas is a hydrocarbon fossil fuel released through fracking and drilling. Royal Dutch Shell is extremely focused on natural gas, and much more so than other energy companies. In the past 5 trading days alone, we have seen Royal Dutch Shell gain more than 18%, and unlike many other energy companies, it didn't see a sharp correction take place on Tuesday. This may signify that the country and the health situation and investors' mindsets are rounding a corner on the recovery and life after the panny. Royal Dutch Shell bought the exploration company BG Group when oil took a major plunge in 2015, 16, and 17, and this may have proved to be massive for the company moving forward. Oil has been taking a beating in the same time frame, but this natural gas spec and diversification acted as a beautiful hedge for Royal Dutch Shell. The thing I love about this company is that they really do value investors. They know their importance in continuing to invest their capital, so they pay back these investors and put their needs first. I know how sappy that sounds, but to be honest, many companies don't care about their investors at all, and it hurts them long run. So it's a mark of importance for me. They also have a very solid balance sheet. They are absolutely massive, have an extremely wide moat, and currently pay out a 4.19% dividend. They are down nearly 50% since earlier this year, and long run these prices will be immense sales. They continue to innovate and diversify their business, and although our world is turning to green energy, Royal Dutch Shell is moving and recognizing this initiative. This company will see another rally upon further announcements of a vaccine and will likely rally for at least the next 3 to 5 years. Anyways everyone, I hope you enjoyed the video. Please hit that subscribe button if you haven't already. I do a ton of videos like this. Smash that like button. It really helps out with the YouTube algorithm. I'd really appreciate it. Anyways, I'll see you all in the next one. Cheers.